Good morning and welcome to the HEADLAM Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to CEO Chris Payne. Good morning to you, sir.
Good morning, and thanks to everybody for joining the session today. So welcome to HEADLAM's half-year results for 2023. I'm Chris Payne, the Chief Executive. I'm also delighted to say, joined for the first time by Adam Phillips, who recently joined us as CFO a few months ago. So welcome to Adam as well. You can see on screen just a brief summary of what we're going to talk about today. So a summary of the half one performance. So we'll have a little look back at half one. There'll be an update on the strategic progress of the activities that we've been carrying out, and then a look forward, both in terms of current trading and how we see the short and medium term panning out. So without further ado, I'll just turn to HEADLAM on a page. So this is about us. For those who are new to the HEADLAM story, this slide's got sort of 4 boxes on it. There's top left, if you like, is around the heritage and the legacy and the experience of the business. We've been around a long time, 30 years, market leading, and we have got some great relationships with customers and many suppliers, mostly in the UK and Europe, but also Turkey and Asia as well. So well-established business, largest in the UK industry. So bottom left, we've got the deepest product range, the broadest and deepest range of products available for our customers, and that stands us apart from competitors, and we're able to give most of our services next day to customers, which obviously is market leading service. Top right, we talk about the network and the scale of the business. In particular in the UK, we've got a very deep range across the country, and we're able to, as I said, offer next day service from an increasing number of locations as well. And trade counter growth is an area that I'll come back to. We're also in overseas territories. We've got a nationwide service in France, and also a nationwide service in the Netherlands. So three geographies nationwide in each of those. And then bottom right, this talks to service, and service is where we focus, and we regularly carry out surveys of our customers, and we do that every 6 months, and we've been doing that for a number of years now, and consistently we're seen as the #1 service provider in the industry, and that's what stands us apart. Again, we're not looking to compete on price necessarily. This is about service and of adding service to our customers, and again, that will be a feature of some of the strategic areas I'll cover very shortly. So that's us on a page. I said, been around a long time, good strong business, good strong balance sheet, and nationwide service across 3 territories. So just a quick look back before I hand over to Adam, who will cover some of the H1 performance in a little bit more detail. So pleasingly, revenue was up actually. So despite the tough market, which will be a feature of some of this commentary, no doubt, it was good to be able to report revenue growth for the first 6 months relative to last year. But that is off the back of weaker volumes. So volumes have been down, particularly in the UK, but with some inflationary benefits and also expanding into new areas. And the second bullet point probably illustrates this best. We've seen the growth areas into larger customer offer and increasing deployment of trade counters help us grow, and the growth really came from the 26.5% larger customer expansion in particular, leaving the regional distribution business where we serve the independent retailer on the high street and the local fitters slightly under year on year, and that does sort of talk to the market, talks to volume, and our overall market share was a little up as a result of the expansion into larger customers. So mixed bag, revenue increases but off slightly weaker volume. And then you look at the profitability, and that's probably the key as to why profitability has been under threat. We've got this perfect storm, unfortunately, of weak residential volume in particular, driven by some of those macro headwinds that everyone's been talking about in various businesses that are coming out recently. Cost inflation also been the second factor. And really a drying up of some of the other sort of industry headwinds or tailwinds that we had in the past, where we've had some price inflation coming through our industry in recent times, which has helped offset inflation in the past. But those headwinds, really, those tailwinds that we enjoyed in the past have now sort of dried up, and we're not seeing cost of goods inflation going forward at the moment. So we've got nothing therefore to offset the operating cost inflation that's coming through. So a bit of a tougher time on profitability and a significant reduction year on year. So what are we doing about it? We are taking some steps to address that. We're taking steps in a couple of areas, and again, Adam will cover this in a bit more detail. But we're doing two things really. One is to look at how we can improve efficiency, take cost out of the business, and indeed we've reduced our operational headcount broadly in line with the reduction in volumes that we've seen to help offset the loss of gross profit and also deliver cost savings in other areas further down the overhead list. So we've been able to support that first half performance to the tune of £5 million to mitigate that decline in gross profit. On the plus side, we have seen some strong cash generation and a sort of return to the operating profit dropping through to cash is a feature of the business for many years. And over the last couple of years, we've seen a bit of a stock build in a difficult supply chain environment. Now that's mostly behind us. We've been able to see a return to cash generation in the first half, which has also meant that the continued investment in the business, whether it's investment in the trade counters or improvement in the operating assets, has been able to be performed out of operating cash. And indeed, we've announced a dividend of 4p with a slightly lower earnings cover that we have in recent times. So we dropped the cover to 1.5 times to protect the ordinary dividend through what is a challenging, but we believe short-term impact on earnings. So a mixed bag of performance in the first half, decent on revenue, challenging on profit, and strong cash generation. So I will hand over to Adam, who will talk a little bit more detail about some of the features of that H1 performance.
Thanks, Chris, and good morning, everyone. I've got a few slides I'll walk you through on P&L, cash flow, and balance sheet. But just on this slide here, just an overall financial summary covering P&L and cash. So just top line there, and as Chris mentioned, revenue growth of 2.5% in the first half. That was a mix of 3.3% growth in the UK and a 2.9% decline in Europe. And in the UK, I've got a customer split we'll cover on the next slide, but that is the strategic growth areas of trade counters and key accounts in particularly strong growth, and that's offsetting some decline in the regional distribution business. Just moving down then to margin. So margin in the first half, 31.5%. That returned to the pre-2021 average of 31 to 32%. And in the previous year, in 2022, we had the temporary margin benefit from the unprecedented price increases that were going through on stock, and that's unwound in the first half of this year. And we'll go through to in Q3 before we annualize that in Q4 this year. Profit then, operating profit 8 million, and I'll take you through a bridge on this in a moment, but that was lower due to the macro and industry headwinds that Chris mentioned in terms of lower residential volumes, high operating cost inflation, as well as that return to the pre-2021 margin levels with the unwind of that price benefit we had last year. Just moving down then, so cash flow. So cash generation was good in the first half, 20 million of operating cash, which is up 35 million year on year. And that left net debt at the end of the first half at about 20 million. And that was actually up 20 million on the end of December. And that reflects investments in CapEx, which is 10 million, and 14 million of shareholder returns, which was a mix of ordinary dividend from last year of 9 million, and then 5 million completing the buyback program, which finished in March this year. So just moving on to revenue, there's quite a bit on this slide, which I won't go through all of it. On the left hand, it just breaks down the revenue even from half one last year to half one this year. UK, Europe, as I mentioned, UK up 3.3%, Europe down 2.9%. On the top right hand side, you can see the split by customer channel, with the larger customers up 26.5% year on year. Trade counters up 8.5%, offsetting that regional distribution decline of 2.6%, taking the UK overall to 3.3% growth, offsetting that 2.9% decline in Europe. And if we just go through volumes, and this chart shows by month from the start of last year, our year-on-year volumes by month. And you can see, and we haven't put an axis on this, but just to give you a sense of scale, so January, as we entered this year, we were mid to high single-digit volume decline, but that had been on an improving trajectory. So from significant double-digit volume decline in kind of summer Q2, Q3 of 2022, that was on an improving trajectory. We've seen that improve all the way through half one this year, and we got down to about -1% on volume in May. June was a bit of an anomaly, actually. June, our volumes were down 9%, which was heavily impacted by weather. Chris will talk a bit more about current trading later, but if you were to plot July and August on here, it's similar to May. We've been about 1% down on volume. So we've seen an improvement in July and August relative to June. So just looking at the income statement overall, we've covered revenue and we've covered margin. I've got a profit bridge, which I'll take you through, but if I just move through this table, if you come to costs, so the sum of distribution costs and admin expenses, so operating costs in total, were up 6.1% in the first half. That included Melrose. So if you exclude Melrose, costs are up 4.1% on a like-for-like basis. And I've got a bridge on the next slide, which I'll take you through those moving parts. Just moving down the slide then, so you've got net finance costs, 2.2 million. They were increased year on year, combination of higher average borrowings plus the increase in the base rate that we've seen in the year. And that took earnings per share for the first half of the year to 4.6p on a statutory basis, 6.1 underlying. And the board declared an interim dividend of 4 pence for the first half, which is 1.5 times cover. So just on the cost then, so we've broken down here our cost movement from the start of last year through to this year's first half. Melrose, as I said, added 1.9 million of cost. We then got 5.8 million of cost inflation in the first half of this year. About half of that is payroll. We had an average pay rise of 7% in the first half of this year, which we'll see carry on through to the second half as well. The other big part of the cost inflation we've seen this year is around energy. And our electricity costs were about triple in the first half of the year in the UK compared to what they were last year. So that took the total cost inflation about 6 million. We've then got strategic investments. So these are cost choices we've made. Predominantly, this is around trade counters. So as we open a trade counter, they take about 12 months to break even. And in the first 12 months, they'll incur about an operating loss per trade counter of about 100k. So as we've been rolling those investments out, we've got some investment costs in the first half of this year. And then offsetting that is the efficiencies and savings, about 4 million of cost savings in the first half. And I'll come on to that in a bit more detail in a moment. So operating profit then, so we had 17.9 million of operating profit last year in the first half, moved to 8 million this year. And if I just take you through the moving parts on that. So volume was a 4 million impact. And volumes, as Chris mentioned, they were 5% lower in the first half of this year. And that was the net of growth in larger customers and trade counters offsetting decline in the core regional distribution. And then we had the unwind of the price benefit of about £3 million this year. And that's the unwind of the price rises we had last year. Strategic investments, 1.8 million, as I mentioned, and then the cost inflation of 5.8. And then offsetting that, all of that was about 5 million of mitigating actions, 4 million of that was cost, and then about 1 million of that was price rises. So put a first phase of price rise through on the 1st of April, and then a second on the 1st of June. So we've had some impact of that in the first half, and that will build as we get into the second half. And then on the cost side, then, so the mitigating actions on cost, there's a part of that is around reducing operational headcount to reflect lower volumes. And then we've had the transport centralisation project, renegotiation of fuel contracts, some targeted price rises, I've said, and then other cost savings. And in total, then that's about 5 million of benefit in the first half. We expect that to increase in half two. We've got further projects on transport, and we've got some further energy sort of cost savings coming through in the second half. Moving on to cash flow then. So working capital in the first half was about flat, and that compares to an outflow of about 34 million last year. So we've seen a stabilisation in working capital this year. And what we've seen over the last 2 years has been an increase in stock prices coming through. So the unprecedented stock price inflation that's come through, driven a working capital outflow over the previous 2 years. We've seen that normalise and stabilise in the first half of this year. And that's allowed that EBITDA to flow through to the operating cash flow line. So 20 million of operating cash inflow in the first half of this year. And if we just move down the rest of the cash flow, we made an investment in Melrose in January this year, which is about 4 million. We've then invested 10 million of CapEx, which broadly splits a third into tray counters, a third into cutting tables, and then we put 1.5 million into solar panels. And then, as I mentioned, 14 million of shareholder returns, so 9 million in June for the final payment on the ordinary dividends from last year, and then 5 million to complete the share buyback programme, which completed in March this year. So that took our net debt, as I mentioned, at the end of the first half to about 20 million, which is about 0.5 times EBITDA. And then just coming on to balance sheet, I won't go through this in any particular detail, but the key point really to make on this is that we've got a strong balance sheet position at Headlam, underpinned by that property portfolio. So that was valued at the start of this year about 150 million. We've got the stock on the balance sheet about another 150 million. And then from a liquidity perspective, we've got significant liquidity headroom. So at the end of June, we had cash and undrawn facilities totaling about 80 million. And net debt, as I mentioned, about 20 million at the end of June, leverage of 0.5. And Chris will come on to our capital allocation a bit later, but we've set a new leverage target, long-term average range of 0.5 to 1 times. So we're sort of sitting at the bottom of that at the end of the first half. And we have got some cash inflow opportunities around freeholds, which we'll come on to a bit later, which will give us some opportunity to come in towards the lower end of that range. And then this is quite a chart I quite like. We've showed this previously, but I think this is quite a good illustration of actually how at Headlam there's quite modest intra-month and intra-year swings in net debt position. So the red line on this chart shows this year to date, or up to the end of June, movements in our net debt balance. So you can see actually it's relatively modest. You get some dips, for example, with the dividend in June, as we then move back up towards the end of the half. And we would expect this line here, this red line, to trend slightly upwards as we get to the end of this year. That's it for numbers. We'll take questions in a bit, but I'll just hand you back to Chris. We can talk through strategic progress in the first half.
Thanks, Adam. So that's the sort of end of the looking back period, and now we're sort of going to focus on an update on what we've been doing from a strategy perspective, and to give some updates on the growth areas with the larger customers and trade counters in particular. So just as a reminder, this slide, strategic pillars, we've published before, and there are 5 pillars here, 5 columns. The left-hand side really talks to this service proposition that I mentioned right at the start. So this is about our offer in the marketplace, in particular to the independent retailers and fitters. I mentioned in here the bullets underneath. We talked about the customer surveys that we do every 6 months, and we remain number one. We've got some new product launches which we've done in the first half, which I'll come back to in a little bit of time. So yeah, that's a key area as we develop new areas of the business and we start to grow our new customer segments. It's imperative that we remain focused on service with our regional customers as well. Second column in is that area where we're looking at developing the business base. So we're looking at broadening our customer portfolios, particularly important in difficult markets as we're seeing now. With volumes under pressure, we've been able to report growth year on year because we've expanded our offer and expanded our base into different customer types. So that's been going well. We've seen particularly strong performance in the larger customer group, and I'll provide a bit of extra detail on that very shortly. Middle column is around operational effectiveness and capability and also efficiency. So Adam described a number of actions we've taken to reduce our cost base, reduce overheads, to trim our cloth according to volumes. But despite that, we've continued to invest in the business, and there's a significant investment going on to update facilities, the equipment, and to continue the investment in new areas as well. So that's a twin focus of reducing cost to serve and operational efficiency, whilst also investing for the future. And on the right hand side, those two pillars are really encapsulated in our ESG. So sustainability and also making Headlam a great place to be and to work are contained in our ESG strategy. And there's a handful of bullets there of things that we've been doing, but we published our updated ESG strategy in our March year-end reporting account. So a relatively sort of modest roll forward on things that we've been doing there, and I'll come back to that towards the end of the presentation. So just a summary of the strategic growth area. So 3 areas here: the multiple customers, the larger customers, the trade counters, and also sort of the new products and brand focus that I mentioned a little while ago. So this is a slide that we shared at the year end, and I'll give a bit of a deeper dive on each of these. I've got 3 more slides coming up where we talk about these areas in detail. But as a reminder, the multiple retailers, larger customers, represents about 1/3 of the market, so it's a significant area. Headlam's had very low share in this space, so we've focused very heavily on the independent retailer and local fitting part of the market, and haven't focused our efforts onto obtaining market share in the larger customers and multiple retailers. So it's an area, key area of the market, lots of flooring bought through this segment, and we've increased our service proposition here, and I'll give you a bit of detail on what we've been doing. Trade counters, similarly an area that's not been heavily focused on by Headlam. Headlam's had 50 odd trade counters for many years, but they've really not been an exploited channel that we've looked to go to market with. It's more of an adjunct to our distribution service. So in some cases they would be a standalone selling unit, but in many cases they would have been just a collection area for customers as part of the distribution centre, rather than a business in its own right. So that's something that we've invested in, set up a new management team, and it formed the basis of the sort of investment in overheads that Adam mentioned in the bridge earlier. So this is a strong area of growth for us, and we'll give an update on that. And on the right hand side, as I said, products and brands. Headlam's got some great product brands and local distribution brands, but in terms of product brands, it's an area that we have invested in, and we think will have a medium term and longer term benefit for the business, both in terms of consumer and customer awareness, also margin protection. So we've launched a couple of products in recent times, and I'll give an update on that shortly. So first one of those are the larger customers. There's a handful of names on here, and for us, we've been developing our proposition, which is very customer specific. So it's a bespoke service offer based on the customer's needs. So certain customers have a different requirement than others. So somebody like Tappy Carpets, of a specialist flooring provider, highly product knowledgeable, and in that situation our service offer is aimed more around logistics, broad range of products, multiple locations across the UK, and it's more of a logistics sort of service offer. Somebody like Homebase is obviously a general DIY type of retailer, and therefore we become more of a product knowledge bank for them. So we're able to curate sort of a handful of flooring products, and again focus on value add. So these types of customers can buy cheaper product directly from manufacturers. So why do they come to us? They come to us for service, good quality, consistent next day service. And we're able to service all of their stores directly rather than through distribution centres. So a very successful start to the year, 26% up on the first half compared to last year, and that's continued actually. We're now seeing that number grow in current trading as we develop these relationships. So here, this is about growing our sort of share of wallet with these customers, not necessarily looking to add a huge number of names to the list. We have reported Screwfix for the first time, so new customer Screwfix who started work with us earlier this year. But it's a lot of this is about growing our share, growing this partnership with these larger customers on a bespoke basis. So yeah, it's pleasing to see that strong growth and that's continued to accelerate in current trading. Trade counters, so a couple of pictures there of recent additions to the estate. Now we've set out in the past a desired kind of rollout program of trade counters. A lot of this is around filling in white space around the country. So Headlam's had a nationwide distribution service, but in many cases, as I mentioned, the trade counter bringing our service and our products to customers in their local communities has been a bit patchier, and as a result of some heat map analysis, chimney pot analysis that we carried out across the UK, we've identified quite a lot of white space and opportunity for us to infill that with new trade counters, bringing our products and service to customers. Originally we talked about that being 90 sites. As we've developed this plan, we said that we would continue to perform and report back on the performance of those trade counters, whilst also looking at where best placed to fill in the white space. So a couple of good things have come out of that. One is that we've been able to reduce the fit out costs of each of the sites. We've learned as we've gone, and we're able now to deliver a lower capital cost for each of the sites. And indeed, on reviewing the map, the 90 sort of become 100. So it makes sense for us to be in around about 100 locations rather than the 90 we had originally envisaged. So from a performance perspective, it's early days in some of these sites. Many of these sites have only been open a handful of months, and they will take a couple of years to get to maturity. But so far, the evidence of the performance of the sites is in line with our expectations. They've performed well, and certainly well compared to the marketplace. So we set the business case up for this a couple of years ago. So they are performing well particularly in today's tougher market conditions. So it's good to see those continue to perform well. And this is something that we just need to watch because they will, as I said, they will take a couple of years to get to maturity, and we're quite early in the phase of that. So these sites they are dilutive to profit in the early days because, of course, when you open a new site, you've got to take on the rent rates, you have to hire 3 or 4 people, and then you open your doors and you take your first order. So they do run a loss in the early period, and then they start to generate profit once they've got over a certain revenue threshold, and then contribute in the longer term. So it's something we'll keep our eye on. We're expecting that to be, as I said, adding perhaps 100 million or so of revenue over the next few years, and we'll keep reporting on the performance of these sites as we go. And then the third slide, just on strategic growth areas, own product brands. The right-hand side shows some of the product brands that we've got, that many of which our customers would recognise. So Lifestyle and Every Room brands are aimed at our customers, the independent retailers. And then further down the page, these brands are more consumer facing. So Crucial Trading, for example, is a product that we target consumers for, albeit that they actually place their orders through retailers. So we are only serving our B2B customers, but the brand is aimed at more of a consumer facing audience. So we've continued to invest in these websites to bring to life some of the qualities of the product, modernize some of the engagement with consumers and customers. We've launched a new product called Every Room in the last year, and that's been highly successful from scratch, generating a significant level of growth as the slide shows. So again, the group was able to leverage its overall kind of size and scale to develop a new product, which is very much of its time. So good quality, well-priced product that we've deployed across the UK in scale, in depth, and customers have really heavily bought into it. So good developments there. Work still to go on certainly some of the website and digital support for some of our brands. So work in progress on this area, but great to see kind of an award-winning product launched from scratch in the last 12 months. A couple of small acquisitions here that we've referenced. One of them in the UK also gives us sort of self-sufficiency in some of these brands for pattern book and sample making, which is an area of constraint in the UK market. It can take some months to launch samples into the marketplace. So by taking on a sort of small business that we're merging into our Melrose acquisition, we're able to be a little bit self-sufficient in some of these sample and pattern books. So good progress made here. And then lastly, on sustainability and ESG, I said that we published our ESG update in March, and in the middle of the page here, it talks to the strategy that we've launched. So just a handful of updates, really. We've MSCI, which is an ESG ratings agency, has published us as a AAA rated business in this space, which is great news. And we have continued the sort of building on the good work that we've already started with respect to some of the developments for people, in particular the sort of health and safety and mental health training has been a real focus for us in the business, and putting all of our leaders through health and safety leadership and training has been a real focus for us in the first 6 months. And we've also we've notified SBTi of our intention to submit our net zero targets to them for validation. So again, a step forward in all of these areas, building on what we'd already published in March. So that's the sort of update on strategy. And I said that I would then focus on the sort of forward look, both in terms of current trading. Adam mentioned I'll cover capital allocation and also a little bit beyond that. So July and August, I think Adam's already mentioned, we saw volumes pretty flat, slight negative, which is where we thought they'd be. We reset our expectations a little while ago, and in light of some of the macro data that we've seen, businesses coming out recently in our space, like DFS, like Wix and Kingfisher and others, have all published similar sorts of sentiments, really, of a difficult residential volume backdrop, tough cost inflations affecting their P&Ls, but revenue trying to be robust. We're expanding into new areas to mitigate that, expanding into larger customers, as I mentioned, and being tough with ourselves on costs. So the volumes remain relatively subdued, and we expect that to continue into 24. So that's a sort of short-term view, but in the medium term, I think there is this pent-up demand. We've seen RMI spend be significantly below and volumes below, 20% below where they were pre-pandemic. So that deferral can only happen for so long, and by broadening our business base out, we set ourselves fair for when that volume does return. And of course, then the initiatives that we've got and the cost control that we've applied means that we should see a significant increase in profit performance. Capital allocation, as Adam said, we've just reframed this a little bit. A couple of areas where we have made some changes. So net debt and the target leverage, we've actually now given a range with a target in the medium term, and I think it shows that we're prepared to use leverage. I think in the past we've given some guidance and we've tended to stay relatively neutral on leverage. So we are prepared to use our balance sheet and we've given some guidance as to where we feel happy and confident with that. We've also committed to the dividend, the ordinary dividend, and we've dropped our cover this year in terms of the interim, and the announcement for the interim was to protect the ordinary dividend. And then on the look forward for surplus capital, that rather than us having a sort of sequential view of M&A, which potentially means you're looking at M&A before you're looking at buybacks and others, we've looked at this now in the round. So we're now looking at all of those capital uses with equal priority. So we'll look at those. What does the market say? What are the best returns? And we can deploy capital at that time. So, some of this has been reset in anticipation of cash and the generation of cash. And for example, we've had a question already coming in about our freehold property. And as Adam mentioned, there we are due to receive some proceeds from the insurers of Kidderminster building, which burned down. And again, there's cash that would become free there. And indeed, looking at how do we make our network efficient, there may well be some freeholds that become available for disposal in the near future. So again, that gives us an opportunity to consider how we may distribute capital should it be deemed surplus at that time. So I think it was good to reframe this. Shareholders certainly have understood it and been welcoming of the clarity that we've brought on capital allocation. So subtle changes, but in anticipation of things to come. And then the final sort of slide from me before we take questions, just to summarise, as I said, we're a well-positioned business with strong, deep balance sheet, great quality service across the country and indeed in 3 territories, market leading, and albeit some short-term macro challenges, some short-term demand challenges in the UK in particular, we are well set for the medium-term recovery of RMI in particular. We've broadened our business base, which should see some revenue and profit growth in the medium term. So, yeah, I think it's just a tough short term with a more positive medium term.
Perfect. Chris, Adam, thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Chris, Adam, as you can see, we have received a number of questions throughout today's presentation, and if I may now hand back to you, kindly ask you to read out the questions, give responses where appropriate to do so, and I will pick up from you at the end.
Yeah, let me kick off. There's a couple. I mentioned that someone's raised a question about freehold property, so let me just close that one out because I've sort of answered it. But the question says that you have a large amount of freehold property and the asset valuation is well above current valuation. Is there an opportunity to centralise and reduce down the portfolio? And as I said, I think it remains a feature of the business, and as we continue to mitigate costs in the light of inflation and also a flat market, some of the efficiencies that we are deploying now and in the future are likely to result in a reduction in our footprint, and that does therefore give us an opportunity to return some disposals and therefore create some cash as a result. So yes, certainly that's something we're looking at. Another question we've had, which is around your recent trading statements include a claim that HEADLAM are making market share gains. Will you back up this claim and publish specialist research? So we have said, and we have published in the past, the name of the agency that we use to prepare our market share data, MTW. So they prepare a regular report for us, both in terms of flooring spend for the whole country and indeed the share of spend that goes through the distribution channel. So although we won't make that research publicly available, as you might imagine, but we will and have referred to the agency who have prepared it for us. And as I said at the start, market share gains are relatively modest. However, most of those gains have come from the growth into new areas. So the expansion into the larger customers have given us some growth and indeed some trade counters. Without that, and if you strip that out, market share is relatively flat. And when you look into the detail, in some areas we're winning, some areas we're flat, some areas we're going down slightly. So it's a bit of a mixed bag. And as I said, we're happily referring to that name in the market, and as I say, that's been a long-term arrangement, and it's something that is very important for us to continue to monitor as we deploy the strategy. Adam, do you want to pick up the trade counter one, for example?
Yeah, sure. So question we've had, trade counters, what is the likely run rate of revenue and profit for a new trade counter once at maturity? So as Chris mentioned, they take a number of years to mature. It's about 5 years. We would expect upon maturity around 2 million revenue, making about a 10% operating margin. Now we've already got some data on this. We've got a cohort of trade counters that are well established and mature already. So before we started this investment program, we already started with around 50 sites. We've got a number of those making quite considerably more than 2 million actually, but 2 million. And having looked at other trade counter estates, not ours, but looked at profiles of what you can expect, that seems quite reasonable to be achievable. And we plan those on a curve, a typical S curve, over 5 years to reach that maturity. And so far we've got a batch that are in there year one. We've got a batch that are coming through into year two, and we're seeing them perform in line with that curve, that maturity curve so far, which gives us confidence that they'll continue to perform in line with those business cases. We've also had a linked question actually, which says here, historically you've guided to a circa £200 million revenue trade counter business. Given you are now targeting 100 sites, not 90, have you revised your target revenue? So I think what the revised 100 rather than 90 allows us to do is it may enable us to hit that 200 million a little earlier, and then yeah, you're right. You'd expect that once those all of the 100 have then matured, beyond that we would expect maybe to exceed the 200 million. But yeah, we compared to the 90, we may get.
It'll be nice for us to get to 150 and then start to talk up the 200, wouldn't it? So I think we're still a way away from that yet. The run rate is still below 100 million, given we've got 50 sites. So yeah, it will be something that'd be nice to guide up once we've got most of the way there. Last question we've got actually at the moment, which says, in a weak market, can you take advantage of further consolidation opportunities? The answer to that is, of course, we are always looking at opportunities in the market for M&A. Now we do have some constraints over us as market leader. We're a big business with some scale. Clearly there is some competition risk and challenges with us buying distribution businesses in our kind of heartland. However, there are opportunities that we do consider where we could complement and expand on strategy, and whether that's geographically or product. Certainly there are opportunities that we would consider should they become available. But as I said, that it really rather depends on the type of business and where it is and the nature of it. So I think a tendency really is to look at things that complement strategy, take us forward, as I've mentioned earlier with Melrose and the patent book business makes sense. But we wouldn't really look at sort of small tuck-in businesses that do very much what we do now.
Adam, that's great. I believe you have addressed all the questions from investors today. And of course, the company can review all questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But before redirecting investors to provide you with their feedback, which one is particularly important to the company, Chris, could I please ask you for a few closing comments?
Yeah, so thanks for everyone for joining the call today. As I said, tough market. I think we're doing some great stuff, expanding our offer, taking on different customers, continuing to invest in the business in the down cycle, and it just positions us in the great position for the medium term when the demand returns. So short-term challenges, but we're working through that, doing the right things in the business, growing our footprint ready for when the market returns. So yeah, thanks for taking the time to join us, and see you again soon.
Chris, Adam, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of HEADLAM Group PLC, we would like to thank you for attending today's presentation, and good afternoon to you all.